Welcome to the deep dive. Today we're jumping into a specific strategy for inherited wealth.
Right. It's about non-qualified annuities, the ones funded with after-tax money.
Exactly. And the strategy is often called the non-qualified stretch. Our info comes from Diversified Insurance Brokers. They focus on wealth preservation, tax minimization.
Good source for this kind of thing.
So our mission, understand the stretch idea, why it matters for you, maybe give you a bit of a financial aha moment, cut through the complexity.
Sounds good, because inheriting these annuities, well, there are a few standard paths.
Like taking it all at once.
Yeah, the lump sum.
Yeah.
Big potential tax bill right there. Or annuitization, turning it into fixed payments.
It locks you in. Right.
Pretty much. And then there's the 5-year rule. Get it all out within 5 years. Again, potential tax issues depending on the gains.
Okay, so those options sound potentially costly from a tax perspective.
They can be. And that's exactly where the stretch comes in as an alternative.
So how does the stretch work differently?
Well, basically, it lets you, the beneficiary, receive distributions over your own life expectancy.
Over my lifetime, not just 5 years or all at once.
Correct. And that's the big deal. It spreads out the income and therefore the income tax you owe. You only pay tax on the amount you take out each year.
Ah, so it softens the tax blow considerably compared to a lump sum.
Definitely. And the taxation method itself is, well, interesting. It's last in, first out, LIFO.
LIFO, meaning the earnings come out first?
Exactly. The gains are taxed first before you get to the original principal, the after-tax money that was put in.
Well, wait, what about the money still inside the annuity while I'm taking these stretch payments?
That's another key benefit. It continues to grow tax-deferred.
So the remaining balance keeps compounding without annual taxes.
Precisely, which can really add up over the long term compared to taking it all, paying tax, and then trying to reinvest the rest.
Okay, that sounds powerful. Are there, like, specific conditions? Can anyone just do this stretch?
Good question. There are a couple of main requirements. First, the original owner must have passed away before starting annuitization payments.
Before they turned it into an income stream. Got it.
And second, you, the beneficiary, have to actively elect the stretch option. And you need to do it within 1 year of the owner's death.
1 year? That's a critical deadline.
Absolutely. Miss that window, and you might be stuck with, say, the 5-year rule.
Okay, you mentioned distributions based on life expectancy. These required minimum distributions, RMDs, how are they figured out? Sounds complicated.
It's actually pretty systematic. Each year, the amount is calculated based on the prior year-end value of the annuity
Okay.
and your life expectancy factor from the IRS single life expectancy table for that year. Then each subsequent year, you just reduce that life expectancy factor by 1.
So it's an annual calculation.
Yeah.
Based on my age and the account value.
That's right. And importantly, when you inherit via the stretch, you actually become the owner of the contract.
I own it, so I have control.
Yes. You control it. You can even name your own successor beneficiaries for any money left when you pass away.
Wow. Okay. So it can potentially continue for another generation?
It can. Though, one point,
Yeah.
you own it, but you generally can't transfer that ownership to someone else while you're alive. But naming beneficiaries gives that long-term planning aspect.
That's a lot more flexibility than I realized. What if I need more money in one particular year than just the RMD?
You can take more. Absolutely. You have access to the funds.
Okay.
Just remember, any amount you take out above that calculated RMD is also taxed as ordinary income in that year.
Yeah.
And of course, it reduces the contract value faster.
Makes sense. Tax on withdrawal. Is it possible the original owner could have, like, restricted my access? Maybe only allowed the minimum?
Yes, that's possible. They could have set up a specific death benefit election beforehand to limit distributions strictly to the RMD amount.
So they could ensure the money lasts longer, potentially?
Exactly. It adds a layer of control for the original owner's wishes. And navigating these choices, the setup, the compliance, that's where firms like Diversified Insurance Brokers often step in to guide beneficiaries.
Right. Getting professional help seems wise here. Okay, let's boil this down. For you listening, what are the key takeaways?
I'd say first, the non-qualified stretch is a unique way to inherit these annuities, spreading out the tax impact potentially over your lifetime.
Offers potential for continued tax-deferred growth, too.
Yes. Second, it generally gives you more control and flexibility compared to lump sums or the 5-year rule. You own the contract.
Understanding those RMDs is crucial, but also knowing you can take more if needed.
Right. And third, that ability to name successor beneficiaries is really powerful for multi-generational planning.
Okay, a lot to consider. So here's something to chew on as we wrap up. How might understanding a strategy like this non-qualified stretch influence your own long-term financial planning or how you think about legacy?
And perhaps what other, maybe overlooked financial tools or strategies might be out there worth exploring for your situation.
Good questions to ponder. That's it for this deep dive. Thanks for tuning in.